Let us see the next question. An importer booked a forward contract with his bank on 10th of April for 2 lakh United States dollar due on 10th of June at the rate of 64.4 rupees per dollar. The bank covered its position in the market at the rate of 64.28 rupees per dollar. The exchange rates for the dollar in the interbank market rate on 10th of June and on 13th June were as under. So 10th of June and 13th June, the exchange rates are provided to us. Exchange rates have been provided to us. On 10th of June and on 30th of June, the exchange margin is 0.10 percentage and the interest on the outlay funds is 12 percentage. The importer requested on 13th of June for extension of the contract with due date on 10th of August. The rates are rounded off to 4 decimal in multiple of 0.0025. On 10th of June, the bank swaps by selling spot and buying 1 month forward. Calculate the cancellation rate, amount payable on 2 lakhs dollar, swap loss, interest on outlay funds if any, new contract rate and total cost. These are the questions. Please go through the question. Before we start writing the answer, we will first of all have understanding of the question. The question is providing the information like this, that on 10th of April for 10th of June, a customer entered into a forward contract with the bank. Language of the question speaks that it is an importer customer. It means that say the customer must have imported goods and for that it is required to make the payment. So it has entered into a forward contract for conversion of the rupees into dollar. What is the exchange rate at which the contract is entered upon between customer and bank? 64 rupee 40 paise. That is what they have provided. At the same time, so the bank also entered into the interbank market, same transaction for sell rupees and purchase dollar, and for that so the exchange rate is provided to us at 64.28 rupees per dollar. So from bank point of view, they had a point like this, that say we are going to enter into the transaction in the international market for purchasing of the dollar at 64.28 and that dollar will be sold at the rate of 64.40 to this customer, and difference of that is 12 paise is the amount of the gain per dollar into 2 lakhs. This is the way the total gain that I would be making. This is what says something. So the must be going on in the mind of bank. However, this time the question is providing the information like this, that the importer requested on 13th of June for extension of the contract with a due date of 10th of August. It means that say indirectly the question is providing the information to us that on 10th of June, so the customer did not come at all. So if at all the customer does not come at all, so on the due date, is that okay? For that, say we are required to read the FEDI rules. That is say, Foreign Exchange Dealer Association rules that we have to read. That if at all you do not come as a customer on 10th of June, the date for which say you have entered for the contract with us, that is with the bank, then what the bank is supposed to do. For that say we have to read the rules and regulations of the FEDI. That is one thing. Second thing that's over here, before we proceed to calculate this kind of answer, I think that all of us are aware that say the customer may cancel the contract before the due date, that is for 10th of June. The customer may come on 10th of June itself for the purpose of cancellation. And this is what say the new point that say we have in this question, wherein it has been provided to us that the customer has come after the due date, that is 13th of June. In that case, what is supposed to be done? So that is what so now we are going to understand. I have provided over here certain portion of the institute publication material. It is like this. Late extension. In case of late extension, the current rate prevailing on such date of the delivery shall be applied. However, before this delivery, the provisions of the automatic cancellation discussed later on shall be applied. Automatic cancellation. As per FEDI Rule 6, that is Foreign Exchange, that is Dealers Association of India, a forward contract which remains overdue. We understand that term overdue stands for that on 10th of June, that is the date on which the customer should have come, however he did not come on 10th of June. After that, it is called overdue. Without any instruction from the customers on or before, the due date shall stand automatically cancelled on within 3 working days after from the date of maturity. It means that say for 3 days, so that is the bank will wait for the customer to come. If at all the customer does not come within 3 working days, then in that case so the contract is automatically cancelled. Though customer is liable to pay the exchange difference arising there, but not entitled for the profit arising from the cancellation. Now what does this mean? I just explained that to you, say with the working. For late delivery, the extension after the due date is mentioned above. The contract shall be treated as a fresh contract and appropriate rates prevailing on such date shall be applicable below. Late delivery. In this case, the relevant spot rate prevailing on such date shall be applicable. Extension after the due date. That is what we have over here. In this case, the relevant forward rate for the period desired shall be applicable. As mentioned earlier, in both the above case, cancellation charges shall be payable consisting of the following. There are 3 things which the customer is required to pay. Exchange difference, the difference between the spot rate of offsetting position cancellation rate and the date of the cancellation of the forward contract after the due date or 3 days. Okay, now it is supposed to be taken as 3 days, whichever is earlier and original rate contracted for. Second, swap loss. This is important. The loss arises on account of the offsetting its position created by early delivery, as the bank normally covers itself against the position taken in the original forward contract. This position is taken at the spot rate and the date of the cancellation of the earliest forward rate or offsetting position. Please highlight this portion. This is what one of the most important word in my opinion over here. Why it is most important, I'll explain you again in the explanation which is yet to be given. Interest on the outlay funds. Interest on the difference between the rate entered by the bank in the interbank and the actual spot rate on the due date of the contract of the opposite position multiplied by the amount of the foreign currency involved in it. This interest shall be calculated for the period from the due date of the maturity of the contract and actual date of the cancellation of the contract, or 3 days, whichever is later. Please note, in above case, there is a profit by the bank on any course of the action, same shall not be passed on to the customer as normally passed the cancellation and extension on or before the due date. That is what it says. Okay. So over here, friends, so let us come back to our question. See, as per FEDI rules, what will happen? Let us understand. Before 13th of June, understanding that say on 10th of June, what will happen? On 10th of June, we can see that say the question is providing to us that bank swaps by selling spot and buying 1 month forward. What does it mean? It means something like this. See, let us say I am State Bank of India and my customer had entered into this contract with me. So of course, in order to say give dollar to him, because he entered into the transaction with me for sell of rupees and purchase of dollar. So he wanted to buy dollar from me. So how can I have dollar with me? So I went in the interbank market. I entered into the forward contract to purchase United States dollar at the rate of 64.28. So on 10th of June, it is mandatory for me say to purchase that US dollar at the rate of 64.28. We understand that so over here the customer did not come on 10th of June. But I cannot escape myself from the interbank, because in that case there is a huge reputation loss, and at the same time in future nobody will deal with me. So what I will do, simply say I will purchase United States dollar at the rate at which it was agreed upon, that is 64.28, and that dollar will be sold in the spot market at 63.80. Because what will I do with dollar? I don't have any use for the dollar currency. And at the same time, I do not know that say when the customer is going to come. He has come over here on that is say 13th of June. However, so I don't know that say when he is going to come. That is the reason say immediately I will enter into a transaction for purchasing of the dollar and selling of dollar at the rate of 63.80. So difference between both of them is like a profit or loss that I will have. 63.80 is price at which I will convert the dollar into rupees, and 64.28 was the price at which I had purchased dollar. So unfortunately there is a loss of 48 paise. Multiplying with 2 lakhs, because so that is the amount for which the transaction was entered upon. So 96,000 rupees is the loss which I have to bear immediately. That is first thing. So this is the immediate loss which I am going to incur. That is the first very obvious point. Now importantly, what happens that as a bank I am responsible to execute this transaction in which I have entered upon with the customer. If at all he comes in the next 3 working days, I cannot deny that say you cannot come. I have to execute the contract. For that, say definitely the rate would be prevailing the date on which he comes. However, I have an obligation. That is the reason say what I will do, I will enter into one more forward contract, say which is the nearest one. In short, on 10th of June, the bank will enter into the swap transaction. First of all, the bank is going to cancel the original transaction. The original transaction was sell of rupees and purchase of dollar. So that original transaction will be cancelled. What is the rate at which it will be cancelled? We understand like this. Spot transaction. It is sell of dollar and purchase of rupees. We understand that so the spot exchange rate is 63.80 rupees per dollar. That is the rate at which it will be cancelled. And at this point of time, again, I will enter into the nearest forward contract. Why? Because I do not know that say when the customer is going to come. So I will enter into the nearest forward contract, say for sell of rupees and purchase of dollar. Because we understand that at any point of the time when the customer comes, at that time I am under obligation so to give delivery of the dollar. So over here, looking to the exchange rates, say which are prevailing on 10th of June, we can see that say this is the nearest one. Over here, friends, they have specified that say the bank is entering into the spot transaction by selling spot, that is selling dollar currency spot, and buying 1 month forward. However, the term 1 month over here is required to be understood as the nearest one. And sell of rupees and purchase of dollar, so this is the rate which will be applicable. So it is 63.95 rupees per dollar. That is the rate which will be applicable for the purpose of entering into the swap transaction. This is what we understand. I am repeating the transaction of 10th of June. Try to understand it properly, friends. We understand that the bank had entered into an interbank transaction for the purpose of purchasing the United States dollar at the rate of 64.28 because the customer was supposed to purchase dollar from me at 64.40. However, on 10th of June, the customer does not come. Even though whatever the interbank market in which the transaction is entered upon by me to purchase the dollar at 64.28, I need to oblige it, I need to execute it. The dollar currency which I have purchased, it is of no use to me. And further we understand that say holding dollar currency is risky. Why? Because if at all the value of the dollar is falling down, then in that case my loss will increase further. So immediately what I will do, in the spot market only I will sell it. So what is the rate at which I will sell it? I will sell it at 63.80. So I will get 63.80. I have paid 64.28. So there is a loss which I am incurring 96,000. Of course, I am going to recover that from customer. But right now, so this is the loss which I am incurring. Now, importantly, what happens, I'd say, understand it carefully. As a bank, I am responsible to my customer if at all the customer comes for the purpose of purchasing the dollar currency as per the original contract in which he had entered upon. He is entitled to ask dollar from me say within 3 working days. Of course, not at the rate at which the transaction was entered upon. At that point of time, whatever the spot rate that would be prevailing will be applicable for the transaction. But still, I will be under an obligation to give dollar to him. That is the reason, say I will enter into the nearest forward contract for the purpose of purchasing the dollar currency. And on 10th of June, the nearest forward contract which was available, in that, so the purchasing rate of the dollar currency is 63.95. Remember that say I am speaking the bank. That is the reason at this point of time, say we do not have to take into account so the exchange margin absolutely. We have to take into account so this interbank market rates for the purpose of calculation. This is what say we understand. See, over here information is provided to us like this, that what is the amount that say we are going to recover? The cancellation charges. In that, the loss arises on account of offsetting position created by early delivery, as the bank normally covers itself against the position taken in the original forward contract. So, offsetting position created by early delivery by the bank. Offsetting position means in the spot transaction which $96,000, sorry, that dollar that you have sold at 63.8. This position is taken at the spot rate 63.8 on the date of cancellation, earliest forward rate for offsetting position. Okay. So now over here we are required to make the computation of the swap loss which the bank is incurring. So calculation of swap loss. In that we can understand that, say, we can compare these two rates directly. On making comparison of these two rates directly, so this is the rate at which you purchased a dollar. So 63.95 is the rate at which you purchased a dollar. And so this is the rate at which you convert the dollar into rupees. So 63.80 is the amount that you receive. So 63.8 minus 63.95. So there is a loss of 15 paise. This is the swap loss into 2 lakhs. So this is the swap loss which I have to recover from the customer. This is what we understand. Now this amount can be calculated even otherwise. How we can compute the same? The swap gain or loss is divided into two parts. One is the actual cancellation that takes place on 10th of June. On 10th of June, whatever the actual cancellation that takes place, in that we understand 64.28 is the rate at which I buy dollar, 63.80 is the rate at which I sell dollar. So difference between both of them is the loss which I am incurring, that is 48 paise into 2 lakhs. So there is a loss of rupees 96,000. Okay, now understand carefully. We know that, say, we have entered into the earliest forward contract. Why? Because at any point of time the customer can come. What is the price at which, say, we have entered into the contract? 63.95. So purchasing dollar at the rate of 63.95. Purchased dollar. If at all this, like, the extension would not have taken place, then in that case we would have purchased it at 64.28. So there is a profit. Why? Because you are able to purchase at a lower rate. What is the rate at which you are able to purchase? 63.95. So there is a profit of 33 paise. Again into 2 lakhs. So you make a gain of rupees 66,000. So ultimately what happens at? So ultimately you are incurring a loss of 30,000 rupees. This is the way the swap loss of 30,000 rupees is calculated. Okay. Now listen carefully. I am going like the time wise. So on 13th of June, what happens at, say, actually the customer comes. So first of all, what we will tell him, that, say, you do one thing, that you cancel your original forward contract. Whether you want to take delivery of 2 lakhs dollar, you want to extend this contract, or you want to absolutely cancel it, whatever you want to do, that I will listen later on. The very first thing that, say, you have to do is, you have to cancel your original forward contract in which you had entered upon. Your original forward contract was to buy dollar from me at 64.28. So you do one thing, that, say, you purchase dollar at 64.28 and you convert that, say, dollar into rupees, say, at the spot exchange rate prevailing on the date on which you have come, that is on 13th of June. Sell of dollar, purchase of rupees, so 63.68. So for $1 we will give you 63.68. From that, so the margin of 10% will be deducted. Why? Because it is sell of dollar and purchase of rupees. So you will be given less amount of rupees. 63.68 minus 0.10%. So it comes to 63.6.63. So over here 63.6.63. So 63.6.63 minus 64.28. I'm sorry, the original contract was entered upon at 64.40 by the customer. I'm sorry. So 63.6.63 minus 64.4. There is a loss of 78.37 paise per dollar that say you have to pay to me into 2 lakhs. So it is 1,56,740 is what you have to pay. In a way, that's a very first thing is that what you have to do is to cancel the original contract. So you can see that's over here, exchange difference. Read this content carefully. The difference between spot rate of the offsetting position means on 13th of June. That is cancellation rate on the date of cancellation of the contract after the due date or 3 days, whichever is earlier. Because what happens that say if at all the customer does not come within 3 days, then in that case automatically it will get cancelled on the 4th day at the prevailing spot exchange rate. As a bank, I will wait for 3 days. If you do not come within 3 days, on the 4th day it will get automatically cancelled. So over here, say the difference between the spot rate of offsetting position on the date of cancellation of the contract after the due date or 15 days, whichever is later, and the original rate contracted for. It means 64.4. So difference of that is the amount of the loss which is required to be recovered from the customer. Second thing that we will tell him that apart from paying this 156,740, you have to pay swap loss of 30,000. We may work out the answer in this way or we may work out the answer in this way. Either of the case, I have incurred a loss of 30,000 because of you, because you did not come on the time. So you have to pay that 30,000 rupees of the loss to me. Plus, because of you, this amount of the loss which I have incurred, that I had to pay on 10th of June. So you have to pay interest to me for 3 days on this amount. So it is 96,000 rupees into 12% because the rate of interest is given as 12% into 3 divided by 365. That is the way the interest is also supposed to be charged. So 96,000 into 12% into 3 divided by 365. So it is 94.68. That is the way, say we are going to collect 156,740 plus 30,000 plus 94.68. The total amount that we are going to collect is 1,86,834.68 from the customer when he comes without listening a single word from him. I do not want to listen to you right now. You want to only cancel? Okay. You want to do extension? Okay. You want to execute the contract? Okay. Whatever that thing that you tell me later on. First of all, this is the amount that say you have to pay to me. Now you tell me what you want to do. Now the customer says that say I want to extend my contract till 10th of August. That is what say he says. That is, he says that say I want to extend my contract till 10th of August. Okay. For the August month, this is the exchange rate which is prevailing, 64.28. So 25. plus 0.10%. Why plus over here? Because we understand it is sell of rupees and purchase of dollar. So the amount of the rupees that say you have to pay will increase. So 64.25 plus 0.10 percentage. So 64.34, sorry 3143. Over here the question is providing the information that say you are required to the question is providing the information that's over here. You are required to make the computation of the exchange rate in 4 decimal in multiple of 0.0025. So over here the new rate which will be applicable is 64.3150. Okay, that is the nearest one that say we will take. This is the way the new exchange rate will be applicable to him. This is what we understand. Now one by one let us go through the questions. The first question is, what is the cancellation rate? We understand that the cancellation rate on 13th of June when the customer comes is, we know that it is sell of rupees and purchase of dollar was the original contract. So now sell dollar and purchase rupees. That is the new contract, and for that the rate applicable is 63.68 minus 0.10 percentage, so 63.6163. So over here 63.6175. Okay, because we are required to round off into like the 0.0025. Second is amount payable on 2 lakhs dollar. It means that say the amount of the loss that say we are going to recover from him immediately, 156740. That is the amount that say we are going to recover from him. So here it is rupees 1,56,740. Swap loss to the bank that we have computed by two methods, an amount of 30,000. Interest that recently that we have calculated something like 94 rupees, that is for 3 days. New contracted rate that I explained to you 64.3150. And the total cost to the customer, wherein we understand that say without listening a single word from him, the very first thing that say we told him that say you have to pay 186,834.68. This is the amount that say you have to pay to me. 186,834.68. This is the way we are required to make the computation of the answer for the question. Over here friends, the institute has given suggested answer like this, wherein they have taken the exchange rate for the calculation of the profit or loss as 63.6163, even though in the first part of the question they have provided the suggested answer of 63.6175. Just to make sure that say we are able to have the reconciliation of the answer, and taking over here 63.6163 for calculation of answer. The second thing is that say earlier this time period was say 15 days. The grace period which is 3 days now, so that grace period was earlier 15 days as per the FEDI rules. It was earlier, instead of 3 it was 15 days. So earlier when this question was asked in examination, in that so the institute had provided so the dates as over here say 15, that is 20th of June, and 20th of June was say within 15 days, and accordingly of course so they had provided the answer because the rules at that time was of 15 days. In a way that say if at all you do not turn in the 14 days, then on 15th day it will get automatically cancelled. Now it is the 3 days only. If at all you do not turn within 3 days, then on the 4th day it will get automatically cancelled. So accordingly they also have changed the information of the question, and accordingly they have provided even the suggested answer. Yet, as far as this profit or loss is concerned, in that say they have kept the exchange rate the same 61.6163. So I am keeping the same for the purpose of calculation of answer. This is the way we are required to do answer. Let us read this content from the Institute publication. As per Federal Rule 6A, the forward contract remains overdue without any instruction from the customer. Order before the due date shall stand automatically cancelled within 3 days after the maturity date. Though the customer is liable to pay the exchange difference arising therefrom, but not entitled for the profit resulting from this cancellation. So there are three things that we understand: swap loss, exchange difference, and the other is the interest. So if at all there is any gain in the exchange difference, then don't pass on to the customer. If at all there is a swap gain, do not pass on to the customer. If at all there is a gain, then in that case no interest will be given to the customer. So no advantage will be passed on. Why? Because say as a matter of the penalty, that say no gain will be transferred to the customer and all losses will be recovered. Extension after the due date, as mentioned above, the contract shall be treated as a fresh contract. And appropriate rates prevailing on such date, that is 13th of June in our example, shall be applicable as mentioned below. 1. Late, in this case the relevant spot rate prevailing on such date shall be applicable. Extension after the due date, in this case the relevant forward rate for the period desired shall be applicable. As mentioned earlier, in both the above case, cancellation charges shall be payable consisting of the following three, and this is very important: the difference between the spot rate of offsetting position, that is the cancellation rate on the date of cancellation of the contract after the due date, or 3 working days, whichever is earlier. Because if at all you do not cancel within 3 working days, then automatically on 4th working day it will get cancelled. And the original rate contracted for 64.40. Second is the swap loss. The loss arises on account of the offsetting its position created by the early delivery, as the bank normally covers itself against the position taken in the original forward contract. This position is taken at the spot rate on the date of cancellation of the earliest forward contract of offsetting position. And third, interest on the outlay funds. Interest on the difference between the rate entered by the bank in the interbank market and the actual spot rate on the due date of the contract of the opposite position, that is 64.28 and 63.8, multiplied by the amount of the foreign currency involved, that is 2 lakhs. The interest shall be calculated for the period from the due date of the maturity 10th of June and actual date of the cancellation of the contract, or 3 days, whichever is later. Please note, in case of any profit by the bank on any course of the action, that shall not be passed on to the customer, as normally passed the cancellation and extension on or before the due date. Now friends, the way I want to dictate the answer to you is ignoring the questions. First of all, I want to dictate the answer to you logically. That basically on 10th of April what had happened, on 10th of June what will happen, on 13th of June what will happen. That is what we are going to write everything logically. And then we will give the answer of the questions. Because basically what will happen in examination, any kind of question can come. But basically you should be clear with the logical sequence. That on 10th of June as a bank, I have to enter into the swap transaction. One, because I have entered into original forward contract, so I will oblige that forward contract obviously. I cannot escape myself. So what I will do with that foreign currency? So I sell that in the spot market, and I do similar forward contract as I enter into initially, because at any point of time the customer may come within next 3 working days. So we understand that say these are the two opposite transactions which are entered upon called swap transaction. So I'll dictate to you on 10th of August, sorry, on 10th of June you will enter into the swap transaction. Then on 13th of August, without allowing the customer to speak anything, we will tell him that say you have to pay three things to me. The first thing is that say you cancel the original forward contract. You want to buy dollar, you want to cancel it, you want to extend it. I don't want to listen anything. So one is the exchange difference. Second is that say for my swap loss you are responsible. And third is that say whatever this cancellation which I had done, for that say actually I had to make the payment of 96,000. So interest on that for 3 days. I'll collect this amount, and then I will listen to him. Let's say he wants to extend it, so I'll give the new rate to him. So this is the way, first of all, we are writing the answer logically, and then one by one the questions that say we are going to answer. This is what say we are doing. In order to try to match with the ICI suggested answer, I am keeping so the exchange rate set that they have kept it, in which uh, I will not round off this, that is the exchange rate for the first calculation, that is in respect of the exchange difference that we are going to see. Let us answer for the question. Heading right down. After due date. Let on first point. On 10th of April, following forward contracts have been entered upon. In the write down, customer with bank sell of rupees purchase of dollar at the rate of 64.40. Bank with customer sell of dollar and purchase of rupees 64.40. Bank with interbank market sell of rupees and purchase of dollar 64.28. So basically the bank has entered into two contracts. One is to buy dollar at 64.28 and another is to sell dollar at 64.40. So this is the way, so it was supposed to make a gain of 12 paise per dollar. That is what we understand initial transaction. Second point, on 10th of June, comma, customer does not come to bank. Full stop. Bank will buy 2 lakh dollar from interbank market at the rate of 64.28 rupees per dollar. Full stop. Bank is not aware when customer will come. Full stop. Holding dollar is risky because value of dollar may fall down. Full stop. Bank will sell dollar 2 lakhs in spot market at the rate of 63.80 rupees per dollar. In bracket write down, we do not have to consider margin. Full stop. With this, bank will have profit or loss of following amount. So on 10th of April for 10th of June, the transaction was sell rupees purchase dollar. On 10th of June for 10th of June, it is sell dollar purchase rupees. Original transaction was 64.28. Sell rupees means payment outflow and purchase rupees means inflow 63.28. So there is a loss of 48 paise into 2 lakhs. So loss rupees 96,000. This amount of loss is required to be paid on 10th of June by bank. Underline the word is required to be paid. So what I want to mention is that say since it is actual cash outflow, so the question of the interest comes. With paragraph write down, as per FEDI rules, customer has a grace period of 3 days in which he can come to buy 2 lakhs dollar as per contract entered upon for 10th of June. In bracket write down, rate will be spot rate and not 64.40 rupees per dollar. So bank will enter into a new forward contract to purchase $2 lakhs, which will have nearest expiry. Full stop. Nearest expiry because bank is not aware that when customer is going to come. Full stop. In bracket write down, in this question, 1 month is given. Full stop. Further, this transaction is implied otherwise. Full stop. For nearest forward, exchange rate for buying dollar is 63.95 rupees per dollar. Calculation of swap gain or loss. Friends, in examination we don't have to write any explanation. We have to write just answer. So calculation of the swap gain or loss will be like this. The first one is the transaction for 10th of June and another is the forward contract. For 10th of June it is sell rupees at the original rate 64.40 and you buy rupees 63 point sorry 64.28 80. So there is a loss of 48 paise into 2 lakhs. So this comes to rupees 96,000. Okay. Now the forward contract in which you have entered upon, in that, say the original price at which you were supposed to buy the dollar was 63.80. New price at which you are going to buy dollar, so original price was 64.28. The new price at which you are going to buy dollar is 63.95. So there is a gain of 33 paise. Again into 2 lakhs. So this amount of the gain is 66,000. So overall what happens, that say there is a swap loss of 30,000. This is the way you can do the answer, or otherwise directly you can take the transaction rates of 10th of June. For 10th of June spot transaction is, initially it was sell rupees, purchase dollar. So now it is sell dollar and purchase rupees. So 63.80, and the forward transaction, it is sell of rupees and purchase of dollar, and the forward transaction is 63.95. Sell rupees means the payment and purchase rupees means the receipt. 63.80 minus 63.95, difference of that is loss of 15 paise into 2 lakhs. This is the way we are required to make the computation of the swap loss of 30,000 to the bank. Third, on 13th of June, when customer comes to bank, comma, he will be told to cancel his original contract. So write down 10th of April to 10th of June, sell rupees, purchase dollar 64.40, rupees per dollar, and on 13th of June you have to do a spot transaction. That is for 13th of June itself, it is sell of dollar and purchase of rupees. So what amount you will get? 63.68. Less 0.10 percentage. Since it is for the customer, so we have to consider this. So it is 63.6163. So there is a loss of 78.37 paise. Okay, into 2 lakhs. So 156740. Loss due to cancellation of original forward contract. Full stop. Further, customer will be asked to make following payment. First, swap loss 30,000. Loss due to cancellation of forward contract is 156740. And third, interest on loss, comma, paid by bank on 10th of June for 3 days. So whatever the loss which the bank had paid on 10th of June, for that so the interest is required to be paid for 3 days. So 96,000 into 12% into 3 divided by 360 or 365, anything that you can take. 94.68. So without asking a single word, this is the amount that you have to take from his pocket. 1,86,834.68. Fourth, customer will be given a new rate for fresh contract, comma, based on rates prevailing on 13th of June. Full stop. It is for 10th of August. So 64.25 plus 0.10 percentage. So 64.3143 that is 64.3150 because we are required to round off the exchange rates up to 0.0025 days rupees per dollar. This is what we understand.